U.S. 10-year at or about 5% is not the end of civilization. I think that's likely normal. That's probably where we're going to be navigating toward. As long as we don't get there in 5 trading days, which causes all that disruption and everyone sort of, everybody on the Treasury desk is always like, hey, what's your job like? It's like months and months of boredom and then, moments and moments of terror.
Been there, yes.
and that's what
you're like a security guard, right?
We've kind of gone through that in the Treasury, and it never just happens gently, right? It's always like, hey, we're hanging out at like 3.9 something percent forever, and all of a sudden we go to 420, and it happens like that, and then things freak out. We're afraid something's going to break.
Welcome to the Futures Edge podcast. I'm Jim Uriel. As always, the brains behind the operation, co-host Bob Iacchino. Today we have an old friend, Chief Market Strategist at B. Riley Wealth, Art Hogan. Good to see you, Art. Thank you for coming.
Thanks so much for having me. I'm very excited to do this. I've been watching you guys forever, and this is the first invite I got. And I even being on vacation, I had to say yes.
Well, so with a guy like Art and Michael Farr, who are possibly good-looking older gentlemen, graying perfectly. I think it's a big thing to get to you without a jacket, correct?
No one is going to believe this was really me. I've never actually been on anything without a tie. I mean, I literally wear a tie and a jacket to the beach. So you guys are actually seeing the most relaxed I'm ever going to be.
Okay, good. So now we have to, the elephant in the room before we do anything else is that, and this is not something that just dawned on me now. This is something that I've thought about for years. The name Arthur Hogan III. Now, Arthur and the third smack of proper generational good East Coast breeding. But Hogan is just your run-of-the-mill Irish name, which I know a lot of drunks who have the same name. Is the complexity in the name a reflection of the complexity in the man?
Well, I would say that's a really good question. So I would say that there's my grandparents, my great-grandparents actually came over from Ireland, named their first son Arthur. He had a son named Arthur who was my dad. He named me Arthur, and then I named my son Arthur. But a funny story is that when I named my son, who's now 26, Arthur Rush Hogan IV, my wife told me right after he was born, we can name him that, but we're not going to call him that because it's such a geeky name. So he actually goes by Rush. So
Rush is a cool name. Yeah. But Art Hogan is not a geeky name, so that she's just wrong about it.
You just made the name not geeky, that's all. Right. Well, wasn't this, again, perfectly coiffed older gentleman of high intelligence and very fine suits? It might end up being a geeky name.
Right. If we had it, it would be. Well, thank you for coming. There is a hell of a lot to talk about. We're recording this Tuesday with the date, the 15th of August. 15th. So today we got the retail sales number that was big and bad. Is that an indication that things are good? Things are better than we thought they were? What do you think?
Yeah, I would tell you this. One of the problems we always have is looking at any point in time as a trend, right? So, if we look at last month, it came in a bit lighter. The month before that, a bit lighter. We thought that the consumer was tapped out and consumer spending was rolling over, and that was surely a sign of things to come. We really like to look at things on a 3-month average and see if there continue to be a string of positives. So, and whenever you make a bet against the U.S. consumer, you tend to lose that bet, right? So, whether it's the ability for the U.S. consumer to be employed, feel confident, have a 401k balance that's higher than it was a year ago, a house that's more valuable than it was a year ago, just feel confident. And then there's a cyclicality of everything. It's like, do you pull forward the back to school spend, which I think we saw a lot of in this last report? You start thinking about, holiday, and what's that spend on? What's that consumption pattern on? And if you look at the makeup of our consumption patterns, it's much more about services than it is goods. That may be coming back to a more normalized level, but we spent, 18 months consuming more goods than services, which we never do. And, for the last 50 years, it's always been 35% goods, 65% services. We turned that on its head for a year and a half, which caused a real pent-up demand for services, which we've seen for the last, call it 15 months. And this summer is no different. I don't know if you guys look at your out of office replies, but everybody's going on vacation still. They just switched from domestic to international travel. So that's where we're at right now. So I think the consumer's in a place where they're feeling, relatively confident. And today was a reflection of that. But if you balance that over the last 3 months, it's moderate. It's not explosive. It's not something that I'm concerned is going to jack up inflation. What it's going to do is gradually normalize back to a place where we're back to what we normally do, 35% goods. We've been under indexing those for a year and over indexing services, and that likely comes down too.
When you look at credit card debt approaching $1 trillion, the slope of it seems impossibly high over the last year and a half. Does that scare the crap out of you as far as the U.S. consumer or no?
It would if I didn't put the denominator in. So if you look at that versus the total savings that we have as a country, right? So if you take that graph and say, okay, what's that ratio look like? Is that normal? Are we above the normalized levels? And we're not. So it's always easy to sort of throw that headline out there and say it's $1 trillion. It's a big scary number. That's the boogeyman. But if you balance that off against, it's like anything else. If debt to equity level, if you were to look at it that way, how much a house is worth, what are the personal savings rates at, what's that total, and then take that debt level and say, is that outside of some historic norms? And it's really not. Now, obviously, it's outsized, but so is our population. The population grows, so obviously the circular debt's going to grow with the population. Probably more granular when you look at default rates. And while default rates have gone up, they're only going up to what we saw in 18 and 19. So, during the pandemic, when everybody had checks being sent to them in the mail and didn't have anything to spend it on, there were no default rates. So that, they went historically very low. And so did personal savings rates, went historically very high. So now that we're back to using, the normalized use of circular debt, and then you balance that against assets and savings in the bank, it's high, but it's not alarming, at this juncture. I feel more like it's certainly explainable and not something that I would run around and say the sky is falling about.
So let me ask you, Art, and I want to go, we got a lot of Twitter questions today. Jimmy put up a Twitter announcement, so to speak, that we were talking to you today, and he said, what questions should we ask Art? And I just decided to write them all down rather than to go through Twitter while we had you on.
Because they were good questions. I was impressed with our guys today. Yeah, right.
So I'm going to go with the first one that wasn't a very good question. How do you feel about the Yankees in last place this far into the season?
Well, that always brings a bit of a warmth to my heart because we were arch enemies, and I think Red Sox fans always feel like we hate the Yankees more than they hate us. I don't know that they give us as much thought as we give them, so I don't think it's equal in size. But I would say the Yankees on paper and the Red Sox on paper look a lot better than both of their records, right? And part of the reason for that is the Red Sox have had so many injuries this year that we're just getting guys back in. So we got this guy Trevor Story, who just came back. His first game was 4 for 4 with 3 doubles. I was like, all right, yeah, maybe we could have used him in the first half of the year. Maybe that's a good sign. We got another pitcher named Sale. He came back. He had a great outing. So get some of the players back. I feel better about this. But unfortunately, in our league and the AL East, you have to be outstanding this year to be in the top 2, right? So we're really just fighting now for that third wild card spot.
Is that Sale the same guy back from the White Sox? Oh, sorry.
It is, Jimmy. No, that's what I was going to say is the first time ever and only time ever in Fenway Park, which, by the way, I loved it. And as a Cubs fan, totally appreciate it because it reminded me of a sort of a bizarro world Wrigley, which is a compliment. Yeah. I actually watched Chris Sale pitch against the White Sox in Fenway Park. White Sox won 1-0. Sale pitched an unbelievable game. Red Sox just didn't hit anything.
Right.
And it was kind of a fun thing. Now, I'm a Cubs fan, so I was actually rooting for Sale on the Red Sox in that particular game, which is kind of like the Yankees Red Sox dynamic with the Cubs and the White Sox, because during the David Letterman top 10 list time of our lives, right, when the top 10 list was everything, you could go to Wrigley Field and there would be somebody selling a T-shirt that said top 10 reasons to love the Cubs. Right. And you'd go to White Sox Park and they had a shirt, top 10 reasons to hate the Cubs. It wasn't top 10 reasons to love the White Sox.
Right. That's fantastic. Yeah, there's a lot of synergies between the Red Sox. Think about the Red Sox and the Cubs. They both have the most beautiful original ballparks in all of baseball, right? They're like museums, and it's just a joy to go to. And, we went for a long stretch without winning a World Series. Both of us, right?
Both teams.
Both teams.
Yeah, so I think that in Chicago and Boston are a lot alike in terms of the dynamics, the makeups, the neighborhoods.
I was on CNBC once. And the question was about the likelihood of something. And I was kind of in thought, and I said, it's like finding an attractive woman at a White Sox game. It's not impossible. It just doesn't happen very often.
Did you say that on live TV?
I said that on live TV. I'm surprised they didn't fire me years ago, by the way.
Good for you. You snuck that one by the goalie.
Yeah, you're speaking to two guys who both got fired from CNBC. So there you go.
What else, Bobby? You got a real question about markets?
Yeah, I got a real question. What is your favorite recession indicator? That's a Twitter question. That leads me to my question was, where are you in the recession camp?
Yeah. So, well, three things. First, there's always going to be a recession, right? There's always a 20 to 25% chance of recession for something. Usually,
Mhm.
what happens is an exogenous event that sets a daisy chain of things happening, and lo and behold, the economy slows down. What has happened in the recent, call it the last 2 years, is a lot of the indicators that everyone leans on just have shown false positives, right? So the leading economic indicators are probably the worst thus far, right? And leading economic indicators have had a pretty good track record of being predictive of recessions. And there's 10 of them, right? It's average weekly hours in manufacturing, average weekly initial claims, manufacturing new orders, non-defense capital goods, ISM new orders, building permits, the S&P 500 equity prices, inflation adjusted M2, 10-year treasuries versus the Fed funds rate. And then the one that I like the least, the average consumer expectation for business and economic conditions. So you look at all that, put it together and say, okay, where do we stand now? And that's been negative for months and months, right? So call it 8, 9, 10 months in a row. But it's an index, right? So in compilation of that index, all of those 10 things are weighted. There's never been a point in time where there's been more than 7 of them that have been negative. And the one that stands out the most, obviously, has been the resilient jobs market. And that's the thing that people just can't get their head around from. The other that's been pretty good as an indicator has been the yield spread, right? The yield curve inversion. So whether you look at the 3-month, 10-year, or the 2 in the 10, the 2 in the 10 is what everyone talks about in the media. And that's been inverted forever. And there's obviously imperfect track record for it, meaning we've had yield curve inversions without having recessions, but we've never had a recession without having a yield curve inversion. So it gets kind of, it gets turned upside down and gets thrown around. The problem with both of those indicators is we keep changing the lag time. It's like, okay, every time this happens in 6 to 12 months, we have a recession. And now we have to shift that out. It's like, okay, in 12 to 18 months, we have a recession. Well, you push that out long enough, and obviously you're going to be correct. Like there's always a recession down the road at some point.
Yeah.
So the one that I think is probably so far hasn't failed is the SOM rule, which is basically taking the 3-month average unemployment rate. And if that goes up 50 basis points or a half a percentage point higher than the lowest of the last 12 months unemployment rates. And that hasn't triggered yet.
What did you call it again, by the way?
It's a SOM, SAHM rule. And
okay, got it.
It's basically, if unemployment goes up by a half a percentage point above the last 12 months. So it's always like a moving average. So the 3-month average has to be 50 basis points above the lowest point in the last 12 months. And backtesting that to 1970, it's never had a false positive. So that's probably the one I would lean against. And it kind of makes sense. If unemployment goes up significantly, the economy is likely to slow. So it's hard to sort of think about that in a 3.5 or 3.75% unemployment rate. You and I sitting here saying, well, if next year the unemployment rate was 4.25, is that really going to, collapse the economy? But it's been a pretty good predictor. So to me, when I was growing up in the business, we thought full employment was anything under 5%. I guess we've changed the rule book on that, but that's the one I would look at now. Just keep an eye on that. And the trigger for that is going to be the weekly jobless claims numbers, and they're nowhere near a level of sort of showing some concern. They'd have to be 300,000 on a weekly basis, and we're nowhere close to that.
So, Art, let me get your opinion on something. You're an MD and a chief strategist at B. Riley Wealth Management, right? So You're a wealth manager. So you must have times where you're trying to convince your firm's clientele that, look, even if there is a recession, I don't want to put words in your mouth, but this is the kind of thing that I say, that even if there is a recession from a stock investor standpoint, almost so what? Because unless inflation is rampant, stocks start going up again during a recession, historically, since 1940 anyway.
Right.
Usually when you're about the first quarter, second quarter, third quarter of a recession, as if, comparing it to a football game, 4 quarters, you start to see stocks go up, and it's usually the start of a new bear market. Do you have to approach people who are concerned
You meant
about
bull market, right?
Yeah, I meant bull market. I'm sorry. I said football, and I'm a Bears fan.
Right.
You're usually looking for a brand new bull market to sort of get your clients ready for. Is that something you have to deal with, where people are calling up saying, there's going to be a recession, I need to take cover, and you're like, maybe not?
Maybe not, yeah. So I would say that the easiest way to make people feel comfortable about that, because in this 24-hour news cycle, and obviously negative news sells much better than positive news, and clearly there's always some wall of worry and some concern that whether it's and the list goes on, like throughout the entirety of this cycle, we've had a different thing to worry about almost every other week. The global central bank currency was going to devalue the dollar, and the economy was going to implode, or all sorts of things. Quantitative tightening was going to do that. The Fed's rapid increase in rates was going to do that. All of this was going to. And the best way to sort of think about that as a financial advisor to talk to your clients is we've built a durable, diversified portfolio, and we're likely going to lose you more money by preparing you for a disaster than we would be to ride out the normal cycles of the economy, right? And so what does that mean? If you have your typical long-term investor in a 60-40 portfolio, except for last year, all of the years in the last 50 years, that has worked. You have done well, and that's why you diversify. And now, of course, there are going to be, more cautious, clients that don't care and say, okay, the yield curve now, I can get 5% on the front end of the curve. Why don't I do that? And what we have to try to explain is, okay, here's the two things to think about that. Yes, you can. But in a year or 6 months or whatever term you've decided to take in, you're actually getting that. But then you have to reinvest that. And what's your prediction of where rates are going to be? And along the way, you're going to miss the 15 or 18% the S&P 500 has been up. So there's that opportunity. That's why we try to say, yes, for the first time in a while, you've got a great opportunity on that 40% that is fixed income to actually get some solid returns that are going to be ballast for your diversified portfolio. And we're going to keep you balanced and out of trouble. But preparing for disasters costs you more money than disasters do themselves. And that's the important thing to sort of get across and just prove that historically.
So Bobby and I have argued about this before in the past when he says how the equities have done during recessions. I will argue that over the last, let's call it 30 years, we've had more of an activist Federal Reserve, probably more activist central bank involvement over the globe. And probably that has more to do with information technology. And like you just said, the news cycle that's everybody, like in a perfect world, we wouldn't even know who the Fed governors were. We wouldn't know their names. Now, I think aside from this time where they seem to be unflinching, but they've never had a reason to flinch, I will still contend that if the burning embers start falling from the ceiling and the recession looks like it's here, I think the pivot's going to happen quickly. Am I crazy with that? Or do you think this time it's different?
First of all, I don't think you're crazy with any of the premise to your argument. And I think it's good to put some historical sort of parameters around that. So people always say that Chair Jay Powell is going through his Paul Volcker moment. Having been around when Paul Volcker was actually the chair of the Fed, you didn't know what the Fed was doing. There was no press conference. There was no Fed speak. There was no transcript. Paul Volcker would go into a room on a Saturday and take the Fed funds rate from 15 to 17. And the only time you found out was when Manny Hanny and Chase Bank raised their prime lending rate the next day. It was like, oh, we must have raised rates by 2%. So think about that in context of what it used to be like to now where there's not an unexpressed thought by anybody around the table, whether they're a voter or not. The difference that I feel here is that the Fed is truly embarrassed by being too low for too long and too late to the game. They were clearly too low, trying to get inflation closer to the target, their asymmetric target of 2%, stayed there for too long, playing catch up. I think that embarrassment has kept them pretty firm in their desire to win against inflation and with inflation now. And I think that when in fact they get around to cutting, it's going to be less about economic activity having slowed precipitously. It's going to be about them being too restrictive. And all I mean by that is, let's say by the end of this year, shelter costs actually come down with reality. So the CPI measures shelter costs a different way than you and I do. Like you and I can pick up the newspaper and look at rent prices. We can certainly look at Redfin or Zillow or any of the real-time data and say, okay, you think rent prices went up? They actually went down in real life, and they've gone down for 7 months. When that catches up with CPI, they'll look at this. And let's say CPI's got a 2 handle exiting the fourth quarter. The PC's got a low 3 handle, and they're sitting at 5.5 at the Fed funds rate. So when they get to be, more than 200 basis points over what real inflation is, they'll likely have paused there for a period of time and say, we're too restrictive at this juncture. I don't think what pushes them in to actually capitulating here is going to be somehow the wheels come off the cart. They could. But I think what happens is they find themselves to be too restrictive, maybe the back half of next year. They start trimming by 25 basis points until they keep that sort of restrictiveness in between 150 and 200 basis points.
So here's where I'm going to push back. And Jim mentioned how we've been arguing about this, right? So I'm really yelling at Jim here. Year over year PCE sitting at about 3.8, I believe. Yep. Somewhere around there. And we had CPI just come out. What was that? I don't even remember what the headline number is. Well, it doesn't matter.
3.2.
Core was around 3.4 or 3.5, something like that. No, I think core was higher. Not important.
Core was higher. The year over year was 3.2. Core was around 4.5, right?
Okay, perfect. Yeah. So if we start to get a slowdown that is not a recession, if the Somme rule doesn't trigger and inflation doesn't get back below 2%, so I go back to a conversation, or I should say a speech, where Jerome Powell says we actually are looking at an adjusted average of 2%. And I remember going nuts saying, I took statistics. I don't know what an adjusted average is. I know what an average is, but I don't know what an adjusted average is, right?
Right.
And so, and his argument was, well, we've been below 2% for so long that we need to be above 2% for quite a long time. If inflation hasn't spiked and we haven't slowed down dramatically, why cut if inflation isn't even in the twos? Now it isn't now, but you're putting forward a case that it could be in the twos if rent equivalent goes down and things. But let's say it's 2.5, 2.4, 2.6. If he's going to get his adjusted average, and we haven't had a spike in inflation, and stocks are doing okay, and here is the end of the question, and stocks are doing okay, why cut? And if stocks are doing poorly, have they changed their mandate? Because they'd only be cutting for stocks.
While I agree with the fact that they continue to call that target asymmetric, and that's kind of a new framework around that over the period of time that we were below 2%. And that was frustrating because our productivity was too high, believe it or not. I would tell you that
everything new is new again with these guys.
I think that the concept that I last heard from Jay Powell when he had a microphone at his press conference was, we're not going to wait till we get to 2% to start cutting. Why is that? Because then we'll be too late, right? Then the trajectory of inflation is coming down too hard and we've overstepped our bounds. So that's why I feel more comfortable thinking that there is some number, call it 150 basis points, between where the Fed funds rate is and where the current reading on inflation is. It starts to whittle down on what they need to be on the Fed funds rate. I think that's probably more likely. And when they mean asymmetric, and I think they mean that. So it depends on when they average that out over. If you can average out over 10 years, then 2.5 is, or 2.25, 2.5 is going to be close enough for government work for them to have said, okay, we're at our target. What they won't do is say 2% is too low and maybe 2.5 or 3% makes more sense. If you look at
they can't say that, right?
They can't, right? But then they're moving the goalpost to them declaring victory. But if you look over the 50-year history of where inflation has been, it's 2% is probably not reflective of what it should be, and 2.5 is probably closer. I just think that they're going to say, how restrictive are we? And how much significant progress have we made towards what we'd like to see? Because I don't think anybody has penciled in 2% well into 25, but I certainly don't think they're going to be raising that entire time. I think the back half of next year will likely cut rates a couple of times.
So here we've talked about being too restrictive, being not restrictive enough. And I'm actually going to direct the first, just a quick answer from Bobby before you give the same question to you. The rates that are currently right now, if we were just to sit back and let them do their work, would they take care of the inflation problem? Are they too restrictive now, Bobby?
I don't think they're restrictive enough right now. And the only reason I say that is because there's so many components that the Fed can't control right now. And they're the only one fighting inflation. Certainly the Inflation Reduction Act is not an act that reduces inflation, right? Because it's a spending bill. So if you literally said, it's literally like, imagine, Jimmy, that it's snowing in your driveway and the people you pay to shovel it didn't show up, because that's what you do. You're out there with like, a little shovel, and your neighbors are throwing with their snow blowers they're
the government
onto your driveway. That's what I feel like is going on. And if you look at the Chicago Fed's Financial Conditions Index, which is obviously a compilation of a lot of different factors that go into total financial tightness or ease, it eased again. Last 2 months, financial conditions have continued to ease, and the Fed's the only one fighting it. Right. So that's why I think they're not restrictive enough. And also, I just want to throw into the mix here, Art. We had Stephanie Pomboy on last week.
I saw that.
Oh, she's so great.
Yeah.
And she threw in something that, what's that?
That's a tough act to follow.
Oh, God, she is so good. But there's also the thing that she threw in, which I think I thought about, but I hadn't really heard talked about that much, is the Fed will probably stop QT before they'll cut rates.
Yeah.
So they'll leave rates static, but they'll actually be easing financial conditions by stopping QT and even possibly going back to small QE. So to you with Jim's question.
I would say yes. Like if all things remain the same and we didn't do another thing and we're at 5.25, 5.5 on the Fed funds rate, that we are likely in a place that the trajectory of inflation continues lower. Now, obviously, there's going to be some bumps along the road, right? We're seeing an increase in energy prices, for a lot of reasons, and that's going to have an adverse effect. But I think when you think about the natural lags, the long and variable lags of monetary policy that everyone talks about, and that really hasn't changed. We still have so much tightening that's still in the pipeline that hasn't really manifested yet. So I think that you've got the ability to look at this and say, we don't even know. Let's say we started this 15 months ago or so, and the lag is anywhere between 6 and 12 months. That means more than half of the tightening we've already done hasn't really had an effect in the economy. But Bobby, you bring up a good point. The difference between the great financial crisis and our response to that, and what we're going through now, and the response to that is it was all about monetary policy back then. There was no fiscal stimulus post great financial crisis to any extent, right? And what we have now is a combination of both, right? And so this is really the bazooka of a lot of stimulus that is going to be hard to unwind, and we're just now unwinding it. Where I feel less concerned about new programs like the infrastructure bill and the Inflation Reduction Act and all of that is they're so long, right, in implementing. It's not like they're saying, okay, here's the billions of dollars we're spending and it's going to get put to work tomorrow. So the only satisfaction I have about that is while I disagree with the amount of stimulus, that the lag in getting that actually from plan to, the money on the street is going to be long until we haven't really started any infrastructure projects. We're going to, it's going to be a longer period of time. So that piece of it is going to be less impactful. But I think, the short answer to you, Jim, I think is this. It's where we are right now. We don't even know how much we've tightened because it just hasn't hit. We just haven't seen the effects of half of what we've done.
Yeah, I look at the Inflation Reduction Act as I'm on a little bit of a fitness kick right now, and I got a cherry pie at the end of that. So it's not going to hurt my weight goals in the short term, but it might affect me down the road a little bit.
Right.
Go ahead, Jimmy.
Can I answer my question too, what I think? And I kind of wanted to get Art's comment on that too. I think you said, we talk about long and variable lags. Why do we talk about that? Is that a Friedmanism, long and variable lags? Of
Yes, it is.
Yes, it is. Yeah.
It is. That's what I think. So I will argue, and I have argued extensively, that this particular moment in time, there's a longer lag because 5 years preceding the first rate hike, U.S. 10-year yields averaged 1.96%. Since 1980, they average about, closer to 6%. My contention is that everybody who had the opportunity to roll into duration, not just individuals, not just people on their mortgages, but business as well, rolled into the duration. So they can just sit back and go, wow, that sucks for that guy having to pay 7% on his mortgage. So in my opinion, it's moving out the lag time. That's valid. Yes.
Oh, 100%. So think about this: 65% of people have mortgage rates that are below 4%. You look at the percentage of S&P 500 companies that have low debt that doesn't need to be rolled over until 2030. So to your point is, when is that going to bite there, right? So and I think that's exactly why we're seeing what we're seeing in housing, which is so disrupted right now. So any given year, historically, home sales would be 90% existing and 10% new home sales. That was 37% new home sales last month. Like, how is that physically possible? It's showing up in the home builders, but it's possible because 65% of people have mortgages at 4% or below. It's hard to get, thank God Bobby moved out of a nice house and that opened one unit up in Chicago.
That loosened up the supply.
That's right. You're not leaving anytime soon. It's hard to sort of understand that, to your point, that this isn't going to hurt, or really we're not going to feel that pain for a longer period of time because everyone looked at this and said, okay, stretch the duration out. S&P 500 companies, did all that they could to push the duration out and won't have to refinance until 2030.
It would be irresponsible not to. Right.
Yeah. So where do we know we're going to be when we get there?
Yeah, I got a question from John off of Twitter. 10-year note, about 420 right now or so. Since last week, it's up, 12, 15 basis points, something like that.
Yeah.
John wants to know if you have an opinion as to where it's going to top out. Now, he didn't give a time frame, so I'm going to assume 2023.
I think Jim puts this in very good perspective for us. What's normal and what wasn't normal was 1.9% for 5 years in a row. If you stretch that out and say, what would normal be? The U.S. 10-year at or about 5% is not the end of civilization. I think that's likely normal. And that's probably where we're going to be navigating toward. As long as we don't get there in 5 trading days, which causes all that disruption and everyone sort of, everybody on the Treasury desk is always like, hey, what's your job like? It's like months and months of boredom and then, moments and moments of terror. Right?
Yes.
and that's what
like a security guard, right?
We've kind of gone through that in the Treasury, and it never just happens gently, right? It's always like, hey, we're hanging out at like 3.9 something percent forever, and all of a sudden we go to 420. And it happens like that. And then things freak out. We're afraid something's going to break. I wouldn't be surprised if we're sort of, exit this year and this sort of call it 4.25, 4.5, eventually find, ourselves closer to 5% for the right reasons. But it's hard to explain to someone that wasn't, that was born in the 90s, let's say, that, oh, by the way, that's actually normal, right? The average mortgage rate over the last 50 years has been something like 5%, right? Or thereabouts, 5.5%. Right. So we just went through this extended period of time where, they were down in, 3.5%. And so we're probably normalizing a lot of things. That's not my biggest concern, where that eventually ends up.
It was really funny. Somebody sent me a video today, Jimmy, and it had to be a mortgage broker. If he was 30, he was 30 and one day.
Yeah.
I mean, he was younger than all of us. And he was in a panic. He's like, 30-year mortgage rates are at 8% now. If they don't change this, the U.S. today can't exist like this. And it was like, we're all old enough to remember.
Yeah.
I mean, come on.
Existed just fine.
Yeah. My first mortgage was in 1986, and it was 8.5%. And it was a variable. And I left the bank blanking. I literally walked out of the bank laughing, thinking I just stolen the money from them. And it never ticked up from there. So, I think it had a cap of like 12%, and it ticked down like every year, just gradually worked its way down. And then you sort of, when I had a little more equity, I started refinancing and sort of coming down. That certainly wasn't the end of civilization. We went through some pretty good things as we, got through the 90s and mortgage rates and the 10-year were much higher back then. So this is a pretty dynamic economy that can likely flourish in the current yield rate environment that we're in.
All right, I decided to make my life hard and go back and credit everybody who sent us a question. By the way, you have the record for most questions on Twitter. We say this every week. We usually get one, maybe two, and we just got a salute from you. But I have to say the recession indicator question, what's your favorite recession indicator, was from White Truck, who is like a huge fan of this show. And he also has a Florida flag in his bio there. So I like him for that. What is your greatest concern for the stock market going forward, and what's the probability of it coming to fruition?
Yeah, it's such a great question. And usually the things we're the most concerned about just never happen, right? So the 2021 timeframe, and our biggest concern was Russia's invasion of Ukraine, and that was going to cripple the food supply for Europe, and it was going to make energy prices impossibly high, and that just didn't come to fruition because we're in a dynamic global economy. Russia's able to sell its oil supply to China and India. There's other places in the world to make food outside of Russia and Ukraine. We got that to Europe. Luckily, they had a warmer winter, so natural gas pipeline being shut down didn't cause that. So that's not what necessarily concerns. When I think about what is the near-term concern I have the largest concern about, we're trying to compare China's reopening with the United States reopening. And it's apples and oranges, right? So, China sort of went through this 3-year on and off again, we're closed, we're open, we're closed, and they had the official reopen. And we just assumed that they were going to bounce back and head right to their target GDP growth rates of 6%. And that hasn't happened. Well, why hasn't it happened? Poured so much stimulus into our economy during that time frame, right? Where we said, okay, you need to stay home to flatten the curve for a couple of weeks. And it just, plowed so much stimulus that no one really felt the effect of that. That's not true of China, right? So now China's in retrospect trying to figure out, okay, how do we get youth unemployment back up? How do we fix our broken real estate market? How is it that we can stimulate our economy? Trust me, they can. They just haven't done it enough in the near term. So we're disappointed about the second largest economy in the world not having its kind of normalized demand for our goods and services. That could get worse before it gets better. And I think that's probably something we probably pay less attention to, although it's been used as a buzzword over the last couple of weeks as we're seeing some of their data coming in to the extent that we can believe it. What I thought was interesting today was they stopped posting their youth unemployment rate because I think it just got to be too high, right? It's like, okay, we're embarrassed about that. Let's just take this out of the picture. Yeah. So that's a piece of the puzzle, I think. Next to that, maybe not equal, but in the sort of bricks that are on the wall of worry, that maybe this Fed doesn't look forward enough or start to say, okay, we need to take a breather here to see how much of this is going to actually bite into the real economy, and stays, to your point, Bobby, that stays over aggressive and says, you know what, we're going to skip the September meeting, but we raised again in November. The core CPI has still got a 4 or 3 handle on it at that juncture, and they raised again, and then they truly do break something. It's not our base case, but it's not impossible. I think this is the first time post a meeting where the vote was unanimous, but it really feels like the post Fed speak parade that we've been going through, it doesn't feel like it was unanimous at all. And I think there's enough dissension to say that's not going to be the mistake that they make, that they go over aggressive. We'll wait and see. Away from that, some of the other things you sort of think about is, the amount of debt that we have as a nation versus our GDP, our total GDP, and that's going to be alarming. But those are the types of things that need to get worked out over a period of time, like when we have our next budget. And when we propose that in the fall, get that passed with bipartisan support, and no one wants to spend any more money. Like either side of the aisle is not going to say, okay, that's going to be one of those things that kind of takes care of itself. Everyone looks at this and says, okay, we can't go through this, this debt ceiling debacle every couple of years. And we need to propose a budget that we can actually afford or come close to affording and not run the kind of deficit we're running. I'm guessing that we're going to see a much more reasonable budget proposal that gets bipartisan support And that likely takes some of that concern away.
Why do you think that? Why do they think they're going to get reasonable all of a sudden?
Well, I don't know. Well, I would say,
That's a good
I'd like to say it has, part of it has to do with they got a little bit of a bloody nose with this Fitch downgrade. It's kind of silly when you think about that. I posted like at one of my Friday irreverent posts was, Maverick, one of my interns saying, what does Abercrombie and Fitch have to do with our debt rating? But, there's not to say that I was being, not taking it seriously, but I think that's a piece of the puzzle, right? But I think when they look at, hey, what are their constituents most concerned about? And, our level of debt certainly, rises to that level. Now, everybody and every constituent wants something, right? And everything that they want costs money. As a room full of people that are supposed to be representing constituents, one of the things that nobody wants is to have our debt get to an unsustainable level. And the only way to sort of balance that out is get to a place where in an election year, neither side is going to try to get something passed that is going to cause the same kind of embarrassment we just went through to get this debt ceiling raised. So I think that, it's going to be impossible to pass something where there's any major new spending initiatives. And I think that when that kind of settles in, it'll be like, all right, okay, maybe things are back, coming back. And if we have, any kind of economic recovery or GDP growth that's faster than what we've seen for the last, 6 quarters, then tax receipts should be better. So I think that starts to pare it down.
And I do love pointing out to people that Republicans are so concerned with spending when Democrats are in office, right? But at least, and I will always argue, they're idiots and they should be consistent. But at least somebody is pointing out the spending one quarter of the time or whatever.
Yeah, 50% of the time someone highlights it, right? But
yes, exactly.
Not on our watch, right? It's just always back and forth. But it just feels like we've gotten to that place where it's impossible to say we're going to pass a budget that doesn't look like it's getting anywhere close to what we can pay for, because it feels as though we're heading in that direction.
Right. Earlier in the show, both you guys, we talked about crude oil, and both you guys, it seemed to be just a consensus, quick agreement that yes, that could be the thing that spurs on inflation. And I've long had a very difficult time understanding the relationship, the cost push, the input price of oil, because at the same time, it obviously goes into the production and transportation of every good. At the same time, it's a tax at the pump, pulling money out of the system. I do think on balance, it's more inflationary than it isn't, but you guys are going to at least give me that it's not as clear cut as, oh shit, you use crude for everything. So if it goes up, it's got to go up. It could be destroying demand as well, Art.
Yeah, Jen, you bring up a really good point. And what's interesting is away from what you and I talk about and think about every single day.
This finger's for Bobby, not for you, because he's shaking his head. Okay, go on, though.
If the average person at your restaurant having a burger and you say inflation, the two things they're going to tell you is what they paid at the grocery store and what they paid at the pump. What they paid at the pump is one of the first things they'll talk about, and then the price of eggs for a period of time, but what they pay at the pump. Problem with thinking about it like that and always thinking about it as like this is so darn much more than it was a year ago is it takes up so much more of our mind share that it actually does our wallet share. So if you just go back for the last 25 years and say, what percentage of our total spend was on energy? Well, 20 years ago, just 20 years ago, it was in the low teens. Like you and I spend in the low teens 20 years ago, that was our energy spend. Now, because we're more productive, we're more efficient, the way everything that uses energy is more efficient, it's about 5%. But it takes up about 80% of our mind share when we think about cost. It shouldn't, but it's just a natural thing. It's easy to do because they put signs up every time you drive by a gas station. Like, oh, 372, what the hell? The world's going to hell in a handbasket. It just isn't that way. So I agree with you. And it balances a bit too, right? So if it's causing inflation, it takes away some consumer discretionary spend.
So I'm telling you this, and I'm being honest right now. There's been 3 separate times of this show where I was so sure of a concept and you totally flipped the script on me and had me thinking a different way. And that doesn't happen to me very often. I really appreciate that. It was before, I can't even remember what they were, but this was a good one too, because that crude oil thing is good. Bob, you agree with that 100% about the crude thing? I know you didn't need to be flipped, but I did. Yeah.
No, I mean, and here's why. Okay, I'm not actually disagreeing with anybody on this. From a purely mathematical perspective, it's a small part. In the same way that I say that like Art has to convince his clients not to worry about a recession, we all should convince people not to worry necessarily about one input price. But what happens is when we look at it being, 5% of the average or 5% is the mean, right? Mm-hmm. Politicians and hence the central bank is always concerned about what it does to the least of us, right? Because no matter you're a billionaire or you make $10,000 a year, you get one vote. Right. Okay. And fuel prices for people who have jobs that are on the lower end of the spectrum is a massive chunk from the political perspective. CPI is an index, okay? And crude oil goes into that index, as does, and Jimmy, you make a point about it, taxes being taken out. It's only taken out at the pump. A barrel of crude oil, we always thought of it in my oil world, it's always 3-2-1, right? So 3 parts of the barrel goes to gasoline, 2 goes to other distillates, and then 1 goes to other things. So it's a very small part of the barrel that goes to other products, but it's a big input price to a lot of those products. So you see an overall push in CPI. Now, I posit to both of you, CPI doesn't matter as much as people think that it does. You could just use the evidence of the Fed looking at your average consumer goes, why do they look at X food and energy when all I care about is food and energy?
Right.
Yeah. So they're 2 different conversations. So when you say, look at the price of energy as to what it does to CPI, it jacks it up. How it actually affects things in the real world, not that much.
Not that much, right?
Interesting.
There's 2 different questions to me.
Yeah.
Okay, let me flip to a different question then. It's something that I thought was important that Steph Pomboy mentioned last week, and several different people on Twitter have told me it's not important because there's reasons why. The shortfall of tax receipts to the tune of about $300 billion so far right now, which is about 7.5% less than what they anticipated. Big deal, little deal, no deal. Art?
I would say on the order of magnitude, 7% probably falls into that. It almost sounds like Nordstrom's coming out and giving you what the slippage was, right? And the shrink was in this past quarter. So yes, it's something we should, be concerned about. I don't know, and this is something maybe you guys can help me understand, how we collect taxes the way we do, right? On the federal level, you owe us taxes. How much? I won't tell you. What if I get it wrong? I'll put you in jail, right? It's like, you know how much I owe you. Why don't you just, let's say
God damn it. Yeah.
I paid you this much, do I owe you more or less? And why do I have to do all the homework on this? It's, so to the extent that we're not a very efficient business, if that's the way we run it, there's always going to be some cracks there. I don't know if it's that important. The larger our GDP gets, the more tax receipts we should have. Our GDP is growing. If the GDP now figures are right, it's going to grow again next quarter. So we're in a positive place. So I think our tax receipts continue to increase, but there shouldn't be that much slippage. It just sounds like, the kind of shrink you have at Target and Walmart. Some other.
Well, like they're having hooded guys break in and steal all their shit. I hope that's not happening to our tax receipts. But Bobby, what do you have to add to that?
Guys in hoodies, be careful how you say things.
That's right.
So John Jensen is the one who asked that, your greatest concern about the stock market and how likely the probability of it coming to fruition was. He also had 2 more questions, but I feel like you answered them both, so I'm not going to ask them. One was bull case and bear case. That was the whole show. Yeah. And I think your view was basically, I'm a little more bullish and bearish, but you should stay invested anyway. Am I wrong on that?
No, I think that's right. I will tell you that when you have the kind of first half that we had this year, and you're up north of 10%, history tells you that August and September could be very choppy. We're seeing that again. It's almost to the day on the calendar.
He also asked if the economy gets better if the Fed goes back to QE, and we talked about that, so I'm not going to ask that. But I want to put, SA was the last question we got on Twitter, and then I have one for you. How long will the yield curve remain inverted, and what's the resolution? I don't know if you know how long it's going to remain inverted, but.
Well, when it was first inverted, everyone was sounding alarm bells off that this was, there was an imminent recession, and it was like waiting for Godot, right? Everyone that got a microphone told you that this always produces a recession, and it's around the corner next quarter. And everyone has had to push that out for a period of time. So we don't know how long it stays inverted, but we do know what some of the causes are, right? Mm-hmm. So we kept interest rates for too low for too long. And then we had to spike them by 550 basis points over a very short period of time. And that's not normal. So it's almost impossible for the Treasury curve to adjust to that in real time. In simple terms, and you guys can correct me if I'm wrong, I think the 2 years is a reflection of where we think the Fed funds rate's going in the near term. That's kind of reflecting that to us. Mm-hmm. And the 10 years is basically reflecting what we think the pace of economic activity is going to be over the longer term, right? So
and inflation.
Right, and inflation, exactly. Yeah. The combination of those 2 things. Add those 2 things together. So the 2 year is predictive of what is actually happening in front of us, right? We've got Fed funds rate that has gotten to 5.5 and it's gone up, precipitously. The 10 year is not sure yet what the pace of economic activity and inflation look like out that period of time. How does that adjust itself? It adjusts itself dynamically, right? The Fed stops raising rates for a period of time. The yield on the 2 year tends to calm down a bit. We catch up to how much issuance we need across the curve, whether it's at the front end or the belly or the back end of the curve. And we get through this massive issuance that we're going through this 3-month period. And then we have a normal cadence of issuance once we've filled the Treasury's coffers. And that likely settles down what we've seen on the 10 year. But it could be for a period of time. It's not necessarily indicative this go round of something other than we had a very rapid increase of monetary policy tightening, and that's gonna skew the curve in any environment.
So you don't see, because Bobby and I have talked about this at length, that steepening, which is an odd way to talk about it because it's actually becoming less inverted, but that a steepening would occur. Historically, it's always been the Fed comes to the oh shit moment and says, oh, God almighty, we got, things are falling apart.
Right.
We have to push the 2-year, Fed funds down quickly.
Right.
We're the two of you are both saying that's not what you see. You see a more gentle flattening or re-steepening of the curve, right?
That's not impossible that the Fed does have to come to the rescue at some point in time. I just don't think it's probable, right? At this juncture, at least not where we stand and what we know right now. So we know we have unemployment at or about 3.5. We know we have inflation at least heading in the right direction, maybe not as rapidly as we'd like. We certainly know that we have a confident consumer that continues to spend. We know that corporate America's balance sheet is pretty solid and their duration is pretty long, so their refunding needs aren't going to be massive. So if we have that as a backdrop, it's likely that happens more gradually. Who knows what happens, a year from now, and the Fed has to come to the rescue, and that's what sort of steepens the curve and pushes down on that. But not our base case right now, for sure.
It is interesting because our research has shown here at Path Trading Partners that the yield curve actually, it goes back to flat, then starts to steepen again. I want to use Jimmy's language because it makes more sense. Mm-hmm. And that's about when the equities bottom. Like there's likely to be another correction in here somewhere, and then they're going to bottom. And as the yield curve comes out of inversion and starts to steepen, the equities will take one last dip and then start to rally back up. That's what's happened since about 1940. So I wanted to ask you a question because I heard something really good today, and I wish I could remember who said it. I hate using somebody else's line without crediting them, but I can't remember. So if you're watching the show and you know who you are, you can yell at me on Bloomberg or something. Somebody said today that we tend to overestimate the value of tech in the beginning of the cycle and underestimate it long term. So with that in mind, where do you stand on AI? Is it overdone right now? Is it just a story that's not a story? I'm sure you have clients calling saying, I need to get into AI. How do you respond to that?
Yeah, a couple of things to think about. And I think the best analog for us to think about is going back to the 90s and the beginning of the internet, right? So we're not there yet in terms of the number of newly minted companies that just put .com at the end of their name came.
So you haven't missed it.
So we haven't gotten there yet. And at the time, go from 95 to like 2000, there was something like 853 newly minted publicly traded companies that put .com and said we have, it's a new paradigm, so you have to value us on, by the number of clicks, the number of eyeballs. This is, what the total addressable market looks like. But there's never had a business. So we're not at that point in time with AI. We're not seeing that massive inflow of newly minted AI companies. So what does that mean? Where are we? Well, what we're doing right now is saying three things. A, who's going to be able to afford to be the near-term beneficiaries of AI? And it's likely the incumbents, right? So it's obviously Google and Microsoft. They've already got the scale to say, we're going to do this. And you can actually make a business case. We're going to make your search, more productive and easier, and we'll be able to monetize that. So both Microsoft and Google, and obviously they've been the near-term beneficiaries. We always sort of look towards, well, that's great, but I'd rather sell the Levi's and the picks and the shovels to these new pioneers in the AI world. And so obviously that's NVIDIA. Now, on the front end of this, since we don't know what the total addressable market is going to be, we always go too far and say, well, of course, NVIDIA is worth, 70 times trailing and 50 times forward, until it's not. And we actually see what those numbers look like. And we'll find that out pretty soon because they're going to report earnings again. One of the first times I've seen a company, the last time they reported earnings, take their guidance up by $7 billion, because that's all they could tell us that they knew at that point in time. But still, you've got a multiple that likely, needs to see some compression. We're starting to see that now. At the end of the day, it's also important to remember the internet was invented by Al Gore back in 1995 or whoever. It was never really used by any of us for another 10 years. Right. We went through this whole .com bubble and didn't really become a part of our, sort of mainstream life. And we didn't actually see companies profiting from that from 10 years. So that time frame likely compresses with AI, but it's going to be a while before we start saying, oh my God, these guys are making so much money because of artificial intelligence. So that's why I would be the most careful and logical about this. Don't get swept up in what might be a wave of newly minted AI companies or AI adjacent companies or, AI business models. Betting on the incumbents probably makes sense, and the picks and shovels guys make sense. But just understand that there's going to be a period of time before this actually gets monetized. And we can say, oh, this was really smart. So, think about what happened to Amazon, which was one of the winners of the dot-com bubble. That had 70-80% drawdowns between, 2000 and 2005 until they started actually saying, hey, there might be something to this internet.
Just a quick question about the AI, and then we'll probably wrap it up. Is we talked about it in the form of where investment money could go. But now from a macro standpoint, you mentioned Al Gore's invention of the internet, which was wonderful, and how I will always argue that technology started advancing so quickly the mid 80s on that was one of the things that was very deflationary, disinflationary. Are we on another cusp of something that could be a very positive factor, like AI making things more efficient, making productivity better, could be disinflationary or deflationary?
No, 100%, right? So the simple equation, right, is what makes GDP, and that's just the size of our labor force, our population, and our productivity. It's just that simple an equation. And if this actually has the ability to make us more productive, which obviously it does, I mean, there should be some guardrails around it, but obviously it does, right? Can you imagine, a couple of years from now, not using something to help you write a better newsletter? It's like, okay, this is what I'm thinking about writing, put it through, and then all of a sudden getting some good advice. It's just like a better Grammarly or a better, software system that is actually going to use artificial intelligence and say, Jim, this would probably sound better if you said something like this. It's like, perfect, put my name on it, here we go. And then multiply that by millions of applications. So yeah, I think it's definitely going to be that sort of productivity increaser that is actually going to increase GDP along with it, right?
Fantastic.
Makes sense.
Yeah, I got two quick things before we go. Number one, I just want to mention to people who follow crude oil that there was recently a warning globally about more and more intense storms coming into the Gulf as we get into the meat of the hurricane season, because we're not there yet. Currently, there's two storms coming off the west coast of Africa. Both have less than 40% chance of turning into a cyclone. But I've gotten to the point where I'm actually watching them coming from Africa to here because we've had nothing. We've had not even a whisper. I mentioned the typical storm that you're hearing behind me. We're having an hour of rain a day and then it's sunshine the rest of the time. And man, that makes me nervous. Having been here almost 4 years now, because there's always something in this place. The second thing is probably the dumbest Twitter question. Makes me believe that you actually know this guy personally. Oh, Mark Parker. You don't know Mark Parker, do you?
I do.
Do you? Because he asked if you still love Maverick and Ziggy, which for people who don't know, those are Art's interns.
Right. Actually, at the end of the year, we went through a review and promote process. So now they're analysts. And both of my kids that are in their early 20s said, now your dogs have the same rank in the company that I have. Now they're, my kids are starting out in the business, they're analysts. And now Ziggy and Maverick are. But yes, there's not a day that goes by where they're not.
You still love your dogs was the question.
What kind of question? I love his dogs. I don't even know his dogs.
Yeah,
they're Cavalier King Charles, right?
Cavalier King Charles. Yeah, Ziggy just had a birthday. He's 10 years old, 10 years young on Saturday, this past Saturday.
That's wonderful.
Yeah.
Oh, fantastic. All right. Well, let's
like
wrap it up. Thanks so much,
better
Art.
than I like people, and I like most animals better than I like Jimmy. So
no doubt about it. I'm cutting you guys off so I can go back with my only friend, Peyton the dog. Someone asked me once, oh, your dog's named Peyton after Peyton Manning? Yeah, like I'm going to name my dog after somebody else's quarterback, okay? Now, what kind of stupid question is that? No, it's not after Peyton Manning.
Best running back in history.
Yes. All right. Thank you so much, Art. Good fun, as always.
Thank you so much, man.
Thank you, guys. That was a lot of fun.